the Nigeria tax reforms. As we are all aware, the tax reforms in Nigeria has been a very long and some would say tortuous journey, right? In fact, if you look at our journey for tax reform since independence, we haven't had any major tax reforms in Nigeria. We have had pockets, but nothing as transformational as this. So I'd say these are really exciting times for us as tax practitioners, but it's also a positive signal for the country. We in PwC have put together a series of webinars that would address some of the key and critical issues within the new tax laws, and also how you as a business need to navigate these changes. We have 4 of our Insight series that we would be having over the next 2 weeks. And today's session will be focused on consumer and industrial products and services, free trade zones and telecoms. In subsequent events, we will be deep diving into other sectors such as oil and gas, financial services. We would have also specific sessions that would cover non-resident companies and also individuals. Today's session would be run by 2 of my colleagues, Kenneth Erikume, who is the head of our tax reporting and strategy group and the chief operating partner of PwC, and Tunde Adedigba, who is director and also supports our tax reporting and strategy group. I've been told that I haven't introduced myself, so I should quickly introduce myself. My name is Telecommunication. I am the tax and regulatory services leader for PwC. So I will be handing over to my colleague, Kenneth Erikume, to take the webinar forward. And please relax, grab a cup of tea, coffee, and we look forward to having a very insightful and interactive session. So over to Tunde and Ken.
All right, thank you very much, Chijioke, for setting the tone for our webinar this morning. Good morning again, everybody. And I promise that this webinar is going to be a very educative and informative one for everyone. Just to let you know, in order to have a very smooth presentation today, I would like everyone to just jot down your questions. You can put them in the chat box. Please, when you are doing that, you can also include your name and the company that you represent. And at the end of Kenneth's presentation, they will take those questions. There's the question and answer session immediately after the presentation. Thank you, everybody. Over to you, Kenneth.
Brilliant. In terms of the agenda for this morning, we are going to be looking at those industries which Chijioke highlighted, which is like the foundation from a real economic perspective. So the consumer and industrial products, the FMCG manufacturing, and industries generally, and retail and services. We're also going to look at free trade zones as well. And we're going to cover 3 areas. We're going to look at the tax reforms, the rationale for it, the implications on these sectors, and then what it means for businesses. I think the first thing to really touch on is the effective date. On 26 June 2025, the president signed the bills into law. The expectation based on some of the commentary and press releases that we've seen is that the law will become effective from 1st January 2026. It's important that people watch out and track the gazetting of the final law to ensure that they understand what this effective date means. On the one hand, the effective date has to be considered from the perspective of transaction taxes. And on the other hand, it has to be considered in terms of income taxes. So what would it mean? Now, the law itself doesn't expressly provide, what it means in terms of the application on year of assessment versus financial year. But it is expected that there will be transition guidelines that would stipulate whether that 1st of January 2026 date means that it would apply from 2026 year of assessment, or it would apply on 2026 financial year. But it's something that everyone needs to watch out for and track to ensure that there are no gaps in terms of implementation. The expectation, so that it doesn't have retrospective application, is that it would apply on financial years that occur after 1st January 2026 to give people sufficient time to plan and execute transactions before the implementation. Now, why did the government go into these reforms? There's several reasons why we've had this. I was having a presentation in France last year on the multiplicity of taxes in Nigeria. And in that analysis we did for a particular industry, we discovered that players in that industry were doing upwards of 60 to 100 taxes payable to different tiers of government. So the reforms that have been implemented tries to deal with, first of all, consolidating and closing gaps with existing tax systems. How do we ensure that gaps and loopholes are dealt with and ensure that there is consolidation of the various taxes, subject to what can be achievable through the Constitution? And of course, the harmonization of tax administration, because we sort of have different tax administrations at the state, the local government, and at the federal level. But what we see is that there is no synergy between all these tax administrations. And what you then have is a lot of gaps. And of course, the third thing is to ensure that processes are digitized and there is equity in the system, so that you have a more progressive tax regime that ensures that there's protection for the vulnerable and the poor, and the rich and the elite also pay their fair share of taxes without favoritism and without any form of preferential treatment. Now, the laws have been that have been passed are divided into 4. So there are actually 4 laws that bring into life this tax reform. And they are, the way we've set them out is that we've put them into what, how, and who. So what are the taxes? These are all consolidated into one law called the Nigeria Tax Act. And this covers what you previously used to call Companies Income Tax Act, Tertiary Education Trust Fund, and all the capital gains tax, value-added tax, and stamp duties tax acts that used to exist. Now everything has been consolidated into one act. In fact, there is only one income tax section. So whereas in the past you used to have capital gains and income tax separated, they've all been brought into one section and taxed at one rate. We then have how. How will the government then implement and administer these taxes? This is done through the act called the Nigeria Tax Administration Act. And it prescribes essentially how tax will be collected, and it covers how tax will be accounted across the 3 tiers of government, and how the revenue from the federation would then be accounted for across the federal, the state, and the local government. Then we also have the Nigeria Service Establishment Act, which as you can anticipate, replaces the FRS Establishment Act and creates this new tax administration at the federal level that harmonizes, the collection of taxes, levies, and duties within one enlarged organization. It also sets out a collaboration framework that allows revenue agencies to share information, to share data, and to delegate authority one to another. And one important thing is also the setting up of compulsory independent state tax administration that would have complete autonomy from the state government and ensure that they're driving IGR within the state. And then you have the Joint Revenue Board Establishment Act that essentially tells you that what we consider to be called the Joint Tax Board is transformed to a Joint Revenue Board that ensures that taxes are harmonized across different states, and different states do not come up with their own agenda. Ensures that data is essentially made available, and enforces and imposes rules for tax administrations in the state and the local government, or frameworks for these subnational tax authorities to operate under. There's also the empowerment and creation of the new look tax appeal tribunal, and something called the Office of the Tax Ombuds, which is essentially to intervene and provide that sort of intervention for those who cannot afford the fees of very well established tax consultants, or do not know their rights. Somebody has to step into that space and provide that support to taxpayers who either lack the literacy or lack the funding. And the Office of the Tax Ombuds will take care of that. But what are the key changes that would impact you and your operations? The first one is that small companies has been redefined. So small companies, previously for you to qualify as a small company, was 25 million and below. That threshold has been increased to 100 million. In the harmonized tax bill, which was submitted after the conference committee was set up between the Senate and the House of Reps. Now, YTBC, we've also seen a version of the bill that some claim to be the final version, carrying a 50 million naira threshold. But until we see the final gazette, it's important that we continue to track that and ensure that companies who are within that range are able to determine whether they are a small company or they're a big company. The small companies will then attract an automatic 0% tax rate on their income, so they don't have to pay any form of income tax. But then above that, the tax rate will be 30%. So there's now a segmentation. Before we had, like I said, the income tax, and then you had the Capital Gains Tax Act. Now, both of that has been consolidated into one act. So what you have is one income tax rate. So if it is a company, the income tax rate is 30%, but it can be reduced by a presidential order to 25% based on the act. For individuals, there's a range of tax rates that ramps up to 25% as well, depending on what sort of revenue you're earning, whether it is what we call trading profits or chargeable gains. irrespective of whether it is capital in nature or revenue in nature, you will be subjected to tax at the prescribed rate under the Act. So, for example, if you sell land and building and you make a capital gain on that land and building, the tax rate is no longer 10%, but 30% based on the Act. Now, if you make normal profits from selling motor vehicles, because that is your normal type of trade, it would still be subjected to tax at 30% until, through a presidential order, the rates are dropped to 25%. So essentially, there is no differentiation between chargeable gains and trading profits. And balancing charge is no longer restricted to the capital allowances you have claimed in the past. Your balancing charge can be, is assessed based on the disposal proceeds minus the tax residual value of the assets, because the rates doesn't differ between capital gains and trading profits. For development levy, this replaces all the ancillary taxes that you had apart from your company's income tax. So where you have tertiary education tax, you had NIDA levy, you have NASENI levy, you have police trust fund, all of that has been consolidated into a 4% of assessable profits. And assessable profits, just for recollection, is the profits before your adjusted profits before depreciation. So it is actually on the same base on which you currently compute your 3% for the purpose of tertiary education tax. So for some businesses, this could actually mean an increase in terms of tax liability as well. Now, these rates, along with the effective date of the bill, is very important, because you now have to go back and look at your balance sheet, especially where you're carrying deferred tax assets or liabilities, at the day where the law has been substantively enacted, to check whether you need to recognize additional deferred tax assets or liabilities relating to some of the balances you have in your balance sheet. The rules for tax deductibility has removed some ambiguity, whilst previously it was wholly, reasonably, exclusively, and necessarily incurred before you deduct. Reasonable and necessary are subjective matters and have been subject to judicial precedents for many years. Now, the tax reforms have essentially done away with those two considerations. And once the expenses are wholly and exclusively incurred, then they should be deductible as long as they've been incurred for the purpose of generating the taxable profits. Now, if a company disposes of shares or an individual disposes of shares, like I said, the rate applicable is just one income tax rate. But the current rules are such that if a person disposes of the shares of a Nigerian company, then they are subjected to capital gains tax. Now, if they do that indirectly, for example, a Luxembourg entity holds the shares of a Mauritius entity that holds the shares of a Nigerian entity, and you dispose of the shares at the Lux entity level, under the previous regime, there would have not been any Nigerian taxation. But in this new law, because disposal can occur at the top level and not at the Nigeria core level, the law has been expanded to cover capital gains through indirect disposal of shares. For non-residents, and my colleagues, Chijoke mentioned that we would also be covering non-residents. We'll do a deeper dive into this rule. But the taxability of non-residents for income tax purposes now builds on the force of attraction rules. And this is particularly important for players in the industries which we are covering today. When you're looking at, construction of plants, where you give out engineering, procurement, and construction contracts. And previously, you could have a split contract, and taxes wouldn't be applicable on the offshore portion, but taxable on the onshore portion. With the force of attraction rules that have been built up, those EPC construction contracts would be fully taxable whether you split the contract or not. And this, like I said, will be dealt with in subsequent series. There's now minimum tax, taking off the rule of 0.05% of turnover. It's now going to be 15% of profits, subject to meeting the thresholds. And the thresholds are two. Once your company is part of a multinational enterprise group, then every profit made, the tax on it cannot be less than 15% of the accounting profits, right? But if you're not part of a multinational group, so you're a Nigerian company, fully Nigerian, but the turnover of the company is more than 50 billion naira, then whatever profits that company makes, the income tax computed cannot be less than 15%. So this is a key change. For the multinational enterprise group, it must be a multinational enterprise group that the turnover is up to 750 million euros, in line with the OECD's proposal for Pillar 2. For non-resident companies providing supplies to Nigeria, there is a minimum tax introduced. The first minimum tax, and my colleagues will take a deeper dive, is that if there is withholding tax accessible on that income, then the tax you pay cannot be less than the withholding tax. But if there is no withholding tax, then there's a 4% tax on turnover 4% tax on profit that the non-resident company must pay as the minimum tax. There's also controlled foreign company rules that have been introduced, where you have a non-resident company that is part of the group or a subsidiary of a Nigerian company that has retained earnings but has not distributed those retained earnings. Under the new law, when the control of that company is very closely held, so 5 shareholders or below, the tax authorities in Nigeria can deem a distribution of those retained earnings and tax them in the hands of the Nigerian parent. Now that, if you do not distribute, then that rule would kick in when the tax authorities exercises that discretion. Now, the interesting thing is that dividends received through approved channels are tax exempt. So it could be a timing difference, subject to whether dividends are distributed in the future. But then if dividends are distributed in the future and brought in through government-approved channels, then it will mean that the withholding tax that has been exercised through the discretion of the tax authorities can be refunded, subject to an application for a refund. We'll go do a deep dive into the free zone tax exemption, because the rules have built up to deal with some of the abuse, in quotes, that have been perpetrated through free zones. The free export processing zones in the past were focused, or the idea was to encourage exports, and sales into the customs territory will now be subjected to tax. But we'll do a deep dive into those rules subsequently. For deductible expenses, you cannot deduct an expense if you have not paid the VAT on that expense, or you have not paid the import duty on that expense. What happens if the supplier didn't charge you VAT? The rules in place under the new law still requires you to charge yourself the VAT that was not charged by the supplier. The way I read this rule is such that, if you do not declare the right amount of duty, for example, you're bringing in a plant and the duty you declared is below the amount which you should have declared at the port, and you want to claim capital allowances on that expense, the way the law has been, the language of the law, subject to interpretation because practice will continue to evolve, is such that I believe that the tax authorities would employ a disallowance of that expense until the full amount of duty has been paid. Then we also have the economic development incentive, and this replaces the pioneer status. And it's not an automatic tax holiday. You have to be listed in those priority sectors. And if you're in those priority sectors, then you can have this incentive for up to 5 years. And the way it works is that you get a credit of 5% on your qualifying capital expenditure, your investment in CAPEX. You get a 5% credit for 5 years, over 5 years. Now, after that 5 years, you can continue to carry the credits that you have not utilized for an additional 5 years, taking it up to 10 years. Those priority sectors, as defined, will be there for up to 15 years, and by natural progression, they will fall off, and new sectors would be introduced into that list. The interesting thing, however, is that the economic development incentive credit also forms part of your minimum tax, and therefore you do not lose it, when you're subject to minimum tax. These are examples of priority sectors as it's currently listed in the Act. There are 31 priority sectors, but we just highlighted, some of the ones, that are related to the industries we're covering today. Electricity and gas supply, even though that seems to be more oil and gas, it's important for the industries within this group from a planning perspective, where you have a power plant driving your manufacturing plant. This could give rise to, the question of whether you can set that up in a separate entity to provide the supply to the manufacturing plant entity and optimize the credits. So there are opportunities to also look at with the advent of this new law. There are other changes which I'll just run through. R&D expenditure, you can deduct, and it allows you to deduct up to 5% of turnover. But if you sell the output of the R&D, whether it's a software or it's a new innovation, then those proceeds would obviously be taxable as well. The interesting thing about capital allowances is that it's now going to be done on a straight line. So you don't have the initial allowance, which will then reduce the balance, and then you have the annual allowance subsequently. So it's now on a straight line, and the rates, could be 10%, it could be 25%, and it could be 30%, depending on the type of plant and equipment that you've incurred. Telecoms infrastructure, actually software, would fall into the intangible assets category, which would be, where you get capital allowances at 10%, which means you get the tax shield over 10 years, as an example. Now, interest continues to be deductible under the new law, which is useful. the definition of what is considered to be foreign related party interest is critical. So the law actually clarifies that the restriction of deductibility to 30% of EBITDA is only on foreign related party loans. So that's very key. But the definition of interest in the charging section of the Act has been expanded, which sort of looks into things that are, like interest, but may not necessarily be interest. So while in the previous law, it was arguable that you get the deduction, that restriction would only apply on interest. In this new law, it seems like there is an expansion of the meaning of interest, such that the restriction can also kick in on forex losses and other fees relating to the loan. There's also the expanded scope of income tax for individuals, and we would have a session that would really focus on this. And the expanded tax base. So the Act broadens the tax base by making it more attractive for people to formalize their businesses. And even where you fall below the threshold, so you're below, you're a small company, it's attractive to operate as a small company versus a business name, right? Or to operate as an individual. So formalizing the business is crucial. But in addition, those small businesses are required to file tax returns so that there are no gaps in terms of tax administration. Input VAT deduction is now allowable, so it's not restricted to goods purchased to resell and goods which form part of your stock in trade used to manufacture a final product. You get your input VAT on services, you get your input VAT on capital expenditure. So the base of claiming input VAT has been expanded. And this is a critical risk for government, as you would recognize that the rate for VAT has not been increased from 7.5%. It's been maintained at 7.5%. But this could give rise to a significant drop in the VAT revenue of government. In 2024, it was in the region of 7 trillion, and it is estimated that it could drop by as much as 40%. So this is one of the reasons why government is looking at the next point there, which is around fiscalization, to ensure that all transactions within the tax net or the economic ecosystem is captured and reported into the server of the FRS. There is now mandatory fiscalization through electronic invoicing or other fiscal devices, which would ensure that there is real-time reporting to the FRS. So while the scope of input VAT has been expanded, the transparency around sales, issuance of invoice, receipts of invoices has also been enhanced to ensure that the tax authorities has visibility over transactions. But what does this mean? For people who manufacture and sell zero-rated goods, it means that essentially, and before I come there, maybe I should just state the general rule. What this means is that the margins of companies will go up because what you used to spend expense along with the expense item or capitalize with the CAPEX, you would now take into your VAT account as an asset, right? So which means that you need to reconfigure your systems to be able to deal with that. And if you're in a zero rating market where you're selling zero rated items, it means that you would always be in a refund position. So you now need to apply to the government for refund. So the way the committee has sort of crafted this is to ensure that essential items, right, whether it is educational, basic food items, medical products, are now zero rated, and they would have the ability to file for refunds. Refunds are payable within 30 days. And if you do not get the refund within that time frame, the law allows you to offset it against future VAT or other tax liability. which is quite expansive. But if you're in an exempt situation, and this is not for zero-rated goods, if you sell exempt items, then it means that you would continue to expense all the VAT that you incur, when you're producing your items or whatever expenditure that you incur. Now, if you sell both zero-rated and exempt, or you sell both vatable and exempt items, it means you now need to track and apportion the input VAT amongst those items. There's a surcharge which the Federal Road Management Agency has not been implementing. It is carried over into this law, which is a 5% surcharge on fossil fuel products provided or produced in Nigeria. The VAT sharing formula, I think everyone is aware, it's been subject to quite a number of conversations in the past. It's also been changed. And this is a list of the VAT exempt items. And this is a list of the zero-rated items. Every other item is subject to VAT at 7.5%. And like I said, the rule for VAT exempt is that you don't get to claim the input VAT. The input VAT that you incur on the expenses on your ERP system, you still have to continue to expense them. For zero-rated items, those are recoverable and you need to file for a refund. If you have split type of supplies, then you need to think of how you apportion between those sales. Penalties have been introduced. If you award a contract to an unregistered person, you pay 5 million naira penalty. The FRS, we've dealt with the issue that it becomes the Nigeria Revenue Service. We've spoken about the autonomy of the states. We've spoken about the tax on boats. Now, tax planning arrangements, there's now a requirement for a disclosure of tax planning arrangements to the tax authorities. So everything that gives you a tax advantage by reducing your tax liability or a scheme, there's now a voluntary disclosure that's required for you to present that scheme and planning arrangements to the tax authorities. So it is just for disclosure purposes. It's not saying that the tax authorities will shut it down. But there is another part of the law that says that when someone takes an incentive that is not in line with the expectations or intention and spirit of the law for which it was intended, then that the general anti-avoidance rules has now been expanded to allow the tax authorities to adjust for those as well. For free zone enterprises, if you export, you fully exempt. Now, if they sell to the customs territory, as long as it is not up to 25%, it is still exempt, right? Up to 2028. From 1st January 2028, once you sell, whatever proportion you sell, whether it is less than 25% or more than 25%, it must be subject to tax. The portion of the sales to the customs territory must be taxed in Nigeria. For related party transactions provided to free zone enterprises, they would be deemed to be that of the free zone enterprise. Sorry, they'll be deemed to be that of the customs territory entity and taxed in the hands of the customs territory entity, except you can show that it's in line with transfer pricing rules. There's also a requirement for incentive reporting of raw materials, equipment as a condition to claim the incentives. So you must provide evidence of the export proceeds, either in cash inflow or imported raw materials. And this also supports and helps with the foreign currency liquidity challenge, but in addition, ensures that the incentive is actually being used for what it was intended. So without further ado, I hand back over to Tunde for us to go through our Q&A. apologies for the time which I took, but there were a lot to actually cover. Tunde, I can't hear you.
All right. Can you hear me now, Kenneth?
Yes, I can hear you. Thank you very much.
Fantastic. Kenneth, thank you very much for that fantastic presentation. I'll just give you 15 seconds or 20 seconds to catch your breath after that wonderful presentation. We have a number of questions ready for you, Ken. And I'm just going through them now, just to ensure that, we see the ones that we can cover as much as we can within the very limited time. Okay, and thanks everybody for the questions. And we'll begin with the very first one from Janil Shah. Janil Shah wants to know when the gazetted notification will be out. When do we expect the Gazette notification of the signed act?
Yeah, so Tunde, if I knew, I would have said it while I was presenting. To be honest, I don't know and I can't tell you. I think we just like we normally do as practitioners or people in business, we need to monitor and track it, and also be on top of transition. The transition guidelines as well, because there's an expectation, because some things would happen. Let's assume it's effective 1st January 2026. We all know that transaction taxes are routine, so it would apply to transaction taxes. But the issue of year of assessment versus financial year, you need clarity in terms of the guidelines and what would the FRS do, even though you can challenge it in court, like we saw with the Ano Gas precedent as an example. But it is expected that for some of these things, there will be guidelines. Some guidelines, for example, have been put in the law, some have not. So, like I told you, for capital allowances, it's now straight line. But if you were doing reducing balance before, and then there's now a new rule for capital allowances, how would you apply it? That has been covered in the law, right? But there are other things that are not covered in the law where there's an expectation that the government or the tax authorities or the committee on fiscal reforms and tax policy will come up with guidelines that would aid and help taxpayers. So unfortunately, I can't give you an answer and say it will come out at this time. We are all watching this space.
Fantastic. Thank you very much, Ken. And I hope Janil gets that also. So we are watching this space, and as soon as we get that notification, we will definitely let the public know. So the second question is from Olga. Olga wants to know minimum tax, the 4% on income for non-tax resident companies. Is this only applicable to the foreign companies having a PE in Nigeria?
Yes, thank you very much. So there is a 15%, which is on profit. And that 15% on profit is applicable to all companies, right? But as you can imagine, the 4% on turnover or income is higher than that. And that 4% on turnover or income is applicable to non-residents. So those that have a permanent establishment or those that have a significant economic presence, so a digital company. And those are foreign entities. So the 4% is for non-resident companies, those, the permanent establishment of a non-resident company or the SCP of a non-resident company, because it's actually higher than, or should be higher than, the 15% of profits, which is applicable to all companies, whether it is Nigerian or foreign.
Fantastic. Thank you very much. Okay. Olga, I believe that is clear. I hope that is clear. So the next question, pardon me, is from Samuel Odebomi. So Samuel Odebomi wants you to clarify, under the undisputed dividend that will be deemed distributed, if not distributed to shareholders, would the FRS tax the dividend that will have been distributed and still distribute same since it will be deemed distributed? That's a bit long-winded. But Ken, I don't know if you got that.
All right, so it's simple. So I have a Nigerian company with a foreign subsidiary. That's the scenario. The foreign subsidiary has retained earnings, but maybe for some reason or the other has not declared a dividend out of those distributable profits. And the rule allows the tax authorities to deem the dividend as distributed. If the tax authorities deems the dividend as distributed, it means that it forms part of the income of the Nigerian parent, and therefore should be taxable in the hands of the Nigerian parent. Okay? And that's what's going to happen if that rule is exercised, because it means that the proof that the income has been brought in through government-approved channels, you will not have, because you did not declare and distribute the dividend. Now, if you're in the other scenario where there's distributable profits and you declare a dividend and it comes into the hands of the Nigerian parents, into the domiciliary account of that Nigerian parent, then that Nigerian parent can justify that it was brought in through government-approved channels. And the exemption applicable to dividend, interest, rent, and royalties brought in through government-approved channels would apply. This is why I say that it is, it could be a timing difference. If in the future, the company then declares the dividends and it's brought in, it will mean that the company paid tax. Let's assume it happened 2 years ago, where the FRS exercised the discretion. The company paid tax, but now qualifies for the exemption. Again, this will be one of the issues that guidelines would have to be provided for to give, taxpayers clarity. But in my mind, a refund would be well in order in that sort of scenario.
Fantastic. Thank you very much, Ken. Because of time, I will ask only one more question. What I will ask our attendees, please, if you can drop your email in the chat box, some of the questions that we will not be able to answer because of time, we can contact you and have those discussions with you. So just one last question, Ken. Kennedy Bashiru wants to know, how can a company that does not have output VAT recover its input VAT?
If you do not have output VAT, you could be in two scenarios. It could be that you should not charge VAT, in which case the supply is VAT exempt, right? So if the supply is VAT exempt, you do not need to charge any VAT. Or it could be a scenario where the supply is zero rated. It means you're charging VAT, but you're charging VAT at 0%, which means there's nothing to pay. Okay? So those are the two scenarios. So you need to determine whether it is zero rated or VAT exempt. If it is VAT exempt, there is no VAT to recover. So when you incur an expense at 100 and you charge VAT at 7.5, what you will expense will be 107.5. But if you do zero rated supplies and then you incur an expense of 100 and there is VAT at 7.5, what you will expense would be 100. You will take the 7.5 debit into your VAT account as recoverable against your output VAT. But because you charge VAT at 0, you will not have any output VAT. You will then need to apply to the tax authorities for a refund. So that application has to go in within 12 months of the transaction. Otherwise, you lose that opportunity. Now, when the FRS has looked at it, they are supposed to give you your VAT refund within 30 days. Now, if they do not give you that refund, because it is your right, the law then says you can offset that, tax refund against any other tax liability, whether it is VAT or income tax, as long as it is accessible by the Nigeria Revenue Service. So that's the way to recover it. I hope that helps.
Thank you very much. I hope Kennedy Bashir is clear on that. Thank you very much, Ken. So like I said, again, please, we will not be able to take all the questions because of time limit. However, please drop your email address or your contact details and in the chat box, and we will be able to reach you and to provide, those responses. All right, we'll go to the next session of our webinar.
I have to refresh. All right. So on this, we would be having a series of webinars, as Chijioke mentioned already, which will cut across financial services, would also be dealing with non-resident. So Olga, there'll be very specific questions that will deal with non-resident companies. There would also be one that deals with energy, utilities, and resources, and so on and so forth. So please look out for the other instructive webinars that are sector specific. Now, as you can imagine, these laws that we've consolidated into this 1 hour session, you cannot exhaust all the points. We've tried to be very intelligent with it to give you some highlights. But, in order to get a deep dive, we are actually going to be undertaking very specific trainings. There's a very, very important training that will be happening on the 17th to 20th of November in Nairobi, Kenya. So it's the non-resident training in Nairobi, Kenya, which speaks to reframing tax, navigating Nigeria's tax reforms amid global trade developments. In there, we'll be doing a deep dive into the tax landscape in Nigeria, VAT fiscalization and e-invoicing, taxation of non-resident companies, tax disputes and resolution, taxation of individual settlements and trust, the tax rules for free trade zones, stamp duties reforms, and petroleum and mining operations. So it will be a real deep dive, and it will be very detailed. And it will be happening on the 17th to 20th of November in Nairobi, Kenya. And for Nigerians, going to Nairobi, Kenya doesn't require a lot in terms of getting the electronic visa. So it will be a time we would really want to spend with you to really focus on some of the issues. As you can imagine, we didn't have enough time for question and answer today, but out there, it will be workshop style, with question and answer, interrupting the facilitator and getting engaged and getting as much value as you can. So thank you very much. With that, I hand over. I can close the webinar. I've been told I can close the webinar. Thank you for joining. And we look forward to having you in our subsequent webinar and to hosting you in Nairobi, Kenya as well. Thank you very much. Enjoy the rest of your day. Cheers. Bye.